What's up, Dividend Gold investors? This is Mike from Dividend Stocks Rock. I hope that you are doing well today. Doing some kind of like a different video today because about a month ago, we discussed covered call ETFs. And I went a bit aggressive in my language. I used a word that I should have not used. So I said that covered call ETFs were scam, which is not true because then I realized that scam is literally illegal or a fraud, which from my French background, I thought, well, my meaning is if you invest in covered call ETF, you're leaving so much money on the table that you're kind of like getting fooled by it because you're just focusing on the income and not getting enough for your money. I mean, you work hard throughout your entire life, you save a lot of money, and then at the end, after making all those sacrifices, financial firms are going to make a lot of money and you're going to retire on those covered call ETFs. It's going to work, but you could have done a lot better. And today I'm not going to compare with my own strategy. I just want to make a small comparison between a covered call ETF and its equivalent, just not investing in covered calls, but just doing the investment in an ETF. In my previous video, I had like strong opinion about that. And today I just want to lay out the facts with using JPMorgan Equity Premium Income ETF, so JEPI. The reason why I use this one is because a lot of commenters just said, you know what, Mike, ZWB, ZEB are not good examples. Like the covered call ETF on Canadian Banks by BMO is not a good covered call ETFs. You should have like taken another one. And the problem with most of those products is they're relatively new. So the reason why I picked ZWB in the first place was because I had more than 10 years of data. So you can see the progression and how each income investment product are reacting to the market events, like whether it's good, whether it's bad, and going through a full economic cycle. Unfortunately, that is like one thing that we cannot do with JPMorgan Equity Premium Income Fund. It started in 2020, in May of 2020. So unfortunately, we will not be having 10 to 15 years of data, only 4, but I just thought of doing it. So JPMorgan ETF, one of like the most popular one, right? So we have a very high yield of like 7.5% right now. Decent expense ratio, so not very expensive here. And the goal is actually to have like a benchmark of the S&P 500 total return and also equity linked notes. So it is and they're obviously selling covered call options on the S&P 500. If we go a little bit lower to see what are the top holdings, we're going to see most of the common names, but not with the same weight. So it's not exactly a perfect replication of the S&P 500, and for that reason, chances are it will underperform a little bit. So we see that when we use the official benchmark from White Chart, they are using the S&P 500. So against the S&P 500 since inception, we are at like 85 versus 59. But again, we're going to look a little bit further about that just than total return, and I wanted to recreate the environment where an investor would retire, invest $1 million in JEPI, and see how it worked. So what I did here in my Excel spreadsheet is I defined a desired income of $5,000 a month. And what we're going to do is the first day of the month at opening, we are going to decide if we buy or sell more units depending on how much income we have received every month. So I started with the first payment that I found on White Chart, which was in July of 2020. First payment of like 49 cents. So I bought enough units to get that $1 million. So we got almost 20,000 units getting paid. So the retirement income for that month is $9,800. So we do have a surplus of $4,800, which we use to buy more unit the following month on the first day that we could trade every time. So we have the price date here. So you can see every first day of the month, we selected the price and then we added the units. So we get a little bit more income every single month. So What is interesting here is when you look at the total income every year. So on this one, we had only 6 months, so it generated 54,000. We needed 30, which is interesting because then we have like plenty of money to buy more units. Going to 21, $87,000. Going to 22, 134, which is great. And remember, that year was a bad year on the market and you made more income. So definitely an interesting point of view here. And then in 23, we go back to 79, almost 80,000. And then right now we are still ahead for 2024. Expected income, like desired income of 20,000, but already made 32. So every single year you could have retired. And as you can see here in the surplus and deficit column, at no time we are selling units, but we get close. Here, for example, like 395, here 333, but most of the times you're more than $1,000 above. I did some calculation here to see what happened during the worst year of that small period of time. And I have to highlight this. We don't have much data, like 4 years is not much to see, but just in case, I mean, I did the calculation between like the portfolio value as of the first trading day. So as of January 3rd here, 2022, all the way down to January 3rd, 2023. So the portfolio went from 1.3 to 1.2 million for a variation of $105,000. So the portfolio decreased by 8%. On top of like just being the desired income. So while you were still retiring on that $5,000 a month, we actually see the portfolio going down by 8%, which is normal. It was a really bad year, but it shows that it did a lot better than the market. And as of April, now we have $1.3 million invested. So the conclusion here is you could have retired with this income. So it's pretty cool because a desired income of like $5,000 a month, which is $60,000 a year, mean also that you are generating more than 6% return on your investment because you invested $1 million and 4 years later you are at 1.3 million. Another thing that was great is every single month we actually bought more units. So you can see that every month we receive money from JEPI, got more money than we needed. So we just bought more units every first single day. So at this stage, I'm not doing market timing. I just set simple rules. First day trade that you can trade every month at the opening price. We're buying or we're selling units. In this case, the number, your units is going up all the time. So now I'm just going to go back to JEPI, right? JEPI, sorry, very tough for a French Canadian to see that. And just going back to say, okay, so what would be my alternative if I don't want to invest in a covered call ETF, but I just want to follow a similar index. So the similar index here in this case is the S&P 500. So S&P 500, what I decided to do is just take SPY. So SPY is one among many ETFs tracking the S&P 500. I didn't do any like research. I just like decided to put minimum effort on that just to keep it simple, literally. And I decided to do the exact same thing. So first challenge I had here is now I had to put the desired quarterly income at $15,000 instead of $5,000 a month because this ETF pays quarterly. Long story short, not going to make that much of a difference. The only difference is now I am making a trade the first day of each month that I am receiving a dividend, a distribution. So in this case, it's every quarter. So as you can see here, every quarter when I need $15,000, like no, I'm nowhere close at any time. So I'm generating between $4,000 and $5,000 a quarter. So I have to sell for about $10,000 of units every single time. So every quarter I have less and less units with SPY. Something that is relatively interesting here, though, is while I'm selling units, the income is actually increasing. So we're like 18,000, 19,000, 20,000, and on our way to pretty much reach probably around 21,000. So the income is a little bit more stable than JEPI. Why I'm saying that is if we go back here, and you want to retire, imagine that you invest in 23, so you see that number last year and you thought, oh, I could actually withdraw $100,000 a year, then you get disappointed, because if you do that, it's still going to work, but then you will have to sell units. So if you don't want to sell units, it's a little bit more variable here, as long as you're staying at $60,000, or you could have even go to up to 79 at this point, that would have worked. In this case, you already know every year that quarterly you're going to sell some units. I did exactly the same situation here, where I looked at the portfolio value as of January 3rd of 22 all the way down to January 3rd of 23. So we started with a value of 1.5 million. So even if you're selling units, the $1 million is actually increasing in value, which was good. But then it dropped to almost 1.2. So for a difference of $335,000, remember, it was 105 just before. So for a drop of 22%. So in terms of volatility, definitely JEPI is definitely better if you don't want to, if you want to sleep well at night. In terms of volatility, that is for sure. As I said before, you are selling more units every quarter. So you can see that the units going down, going down, going down. However, after the same 4 years, if you have retired investing $1 million, generating $60,000 a year in income, your portfolio value now is 1.572, so almost 1.6 million. So what to make of it? So some good, some bad in both cases. So let's take a summary to see what really happened. As you can see, I'm not sharing my opinion. I'm not telling you what to do in this video. I just want to show you the life if you invest $1 million in JPMorgan Covered Call ETF, or if you just keep it simple and invest in the ETF and generate the same amount of income. So here, we're not doing market timing. We're not trying to do anything different than selling or buying units after every time that we receive income. So starting amount for both of them, $1 million. We receive $60,000 a year in both cases. The income here is a lot higher, but it is variable. So we go from like 87 to 134 to 79. So it is important to not retire on the full amount on a single year that JPMorgan Covered Call ETF provides you, because then you may have some surprise and may be forced to sell some units, which would not necessarily be the worst case scenario, but just to keep that in mind. Now, if we look at SPY, we have low income forcing you to selling units, but the income is still growing slowly but surely. So the number of units, we saw that very clearly. Every month we bought more. Here, every quarter we sell more. In terms of transaction, a little bit more action for JEPI because we are making action every month. So 12 transactions per year. Here we're doing 4. So in terms of like energy and time consumed, pretty much the same, to be honest, but it's just to keep in track and have like a very solid plan in both cases to make sure that you do not do market timing, you do not doubt, you do not get stuck by paralysis by analysis, and you just follow what we have established. Is the income sustainable? In both cases, yes, because in both cases we end up 4 years later with more than $1 million. So it opens the door to think that we will be able to generate that for a long period of time. I still have to put just a small note here, though, is withdrawing 6% of your portfolio every year is likely going to fail at one point for a very long period of time. Sorry, I had to cut that. You probably heard my dogs. So what I was saying is, in terms of sustainable income, both has been able to sustain the same $60,000 per year. Again, for a very short period of time, but still that worked. Now, where there is a big difference is the first thing is what happens when the market goes down. So we were lucky because we had a bad year on those 4 years. So we saw how both investment products reacted. So of course, both of them dropped. One dropped by 8%, the other one by 22%. So the difference here, again, going for JEPI, up $230,000 better, and then the difference in percentage is like 14%. So definitely a pretty solid case if you are worried about volatility. However, I would just highlight the fact that your portfolio still dropped by 8%, so there's still volatility, and the amount of income goes from like 80,000 to 134 to go back to 80,000. That is also a level of volatility. So when investors are telling me, yeah, invest in this type of investment product because it's like super easy, I get the money every month, I don't have to do anything, it's not exactly true, because if you don't reinvest all that money in JEPI, you're not going to get the same types of results. So every month you have to make a transaction and you have to rebuy more units. So you are making an action, you have to monitor your portfolio, which is a good thing. But just going there and thinking, oh, I'm going to withdraw like $100,000 a year from JEPI, it's probably not gonna work very well. But just to have that in mind, in terms of volatility, it is more stable than SPY, that is for sure. On the other side, as of April of 2024, so roughly 4 years in, you have either a portfolio that is worth 1.3 million or one that is worth 1.5, almost 1.6 million. So the difference is $234,000 or 17%. That is huge as well. So while the Covered Call ETF did not fluctuate as much as the index fund, after 4 years, you still left $234,000 on the table. So you take it as you want. I'm not going to tell you what to do, but by keeping it simple, following a clear plan, very easy, and that's not even my strategy, it's just like looking at a covered call ETF on the S&P 500 or just the S&P 500. That's the comparison that we just did here. We see that on one side, it is less volatile, but still you're going to go through some volatility in terms of income, and still the portfolio value could drop 10% because it dropped by 8 not too long ago. And on the other side, if you go full invest in an index fund, you will have a little bit more volatility for the portfolio value. But if you focus on income and every quarter you just sell your units, you end up with the same $60,000 a year for the same 4 years with the same amount of like time and energy spent on this one. No market timing, no trying to figure out what's going on, but you have more than $200,000 in your pocket. That's only after 4 years. Again, 4 years, not much. If the trend continues, we're going to do this video after 10 years, and the difference will be worse than the covered call ETF on banks. I hope it's not the case for you guys. If you invest in JPI, and still you can retire on it, that's still working. Now, if you're looking to get more conviction in your portfolio and your investment, because what I see here and what I read in the comment is a lot of investors, they want that income because then they get that conviction that somebody else is taking care of their retirement plan, and they rather invest with a JPMorgan product to receive the yield because they do not have to look at what's going on inside that product. They receive the distribution every month and they don't mind about anything else. With SPY, if you have the same level of conviction, it's pretty much the same thing. You invest, you follow the plan every quarter, you just look at what you need, you sell those units, and then you keep on your life. That doesn't require much time, that doesn't require much attention or energy, or you don't have to figure out anything. And yet, still 4 years down the road, this solution generates the same level of income, and even better because it looks even more sustainable over the long run. So what I would suggest you to do is to consider both options, looking at what's going on here. On May 30th, I am sharing my investing strategy, and I am teaching investors how they can build a portfolio, create their own income like this, focusing on dividend growers instead of dividend yielders, and that makes a huge difference. The webinar is 100% free. You can register right there. So it's in the link description below. I'm going to see you there. I'm going to answer all your questions. And in the meantime, if you want to comment on this video, you're more than welcome. Tell me if you love JEPI or if there's anything that I've missed in this video in terms of like the math or the perceptions or anything else that could be considered. All right, I hope that you have enjoyed this video. Don't forget to give me a thumbs up if you did, and we're going to talk again next week. Until then, don't forget to stay invested.